Hello. Today we're going to talk all about charitable giving. And we're going to talk about quite a few things, but it's only going to be kind of a surface level exploration. So here's our roadmap. We're going to talk about some of the history of charitable giving. We're going to talk about some of the limits and rules that are out there, the types and what you can give to charity, and some strategies and tips and tricks here at the end. As you probably know, the end of the fourth quarter, really in December, is when charitable giving seems to be at the forefront of everybody's mind. Not just the donors, but also the charities as well. And that's why you start getting a lot of letters and emails and outreach asking for your donation. So before I go on, we have to do disclaimers, of course. So I'm going to talk about some strategies here, but before you do them, you need to check with your tax professional, maybe an attorney, a financial advisor, whoever, to make sure that they're the right call for your specific situation. So some facts and figures about charitable giving, and this is from Giving USA. So in the US, charitable giving in 2024 was almost $600 billion. So that's more than 2% of the US GDP. And nearly 400 billion was by individuals. So if you want to think of it, basically 2/3 is by individual people, not foundations, not companies, individuals giving of their hard-earned money. I thought this was really interesting. So income taxes started as we know it, started in 1913. Charitable giving was first allowable as a deduction in 1917 with the War Income Tax Revenue Act of 1917. And you can see the definition there on the screen, but I wanted to highlight it's basically the same as it is now. There's not a lot of changes in what qualifies as a charity. I thought that was kind of interesting. So when we're talking about the basics, and this isn't going to be an issue for most people, but there are limitations to make sure that you're not taking advantage of the tax code. So depending on how you're making contributions to charity, you are limited to a certain percentage of your adjusted gross income on your taxes. So it's not like you can earn $100,000 and find a way to give away $100,000 and have your entire taxable amount be wiped away. They're not going to let you do that. There are limitations on here. So when you're thinking of ways to give, just remember you may butt up against that wall. But again, this is not an issue for most people. There are some new rules, however, from the One Big Beautiful Bill Act that was signed in July of 2025. So if you're someone who itemizes on your taxes, you have a hurdle rate now. Gifts have to exceed 0.5% of your adjusted gross income before they qualify for a deduction. And the total value of the itemized deductions can't reduce your tax bill by more than 35% of the amount deducted. So again, this is something that's not going to affect most people, but it is a new limitation put into place. If, however, you do the standard deduction, things are actually a little better for you. You can now do $1,000 for an individual or $2,000 for married filing jointly in deductions based on how much you give to charity. So obviously if you only give $500, you can't write off $1,000. But if you give $1,000 or $2,000 if it's married filing jointly or more, you can write those off even if you're under the standard deduction. Now the ways people give to charity are varied, but the most popular is cash. And by cash I mean physical currency, but it also could be a check or done via credit card. It's considered a gift on the day that you put your check in the mail, the day you text to give, the day you charge a credit card. It's that day is when it's credited. So even if you mail something out, a check out on December 31st, as long as you can show that that check was sent out on that day, it doesn't matter when it was received or cashed by the charity, it still counts as from that year. And I mean, one of the ways that makes cash the easiest is $1 equals $1. So you don't have to worry about valuations. $5 equals $5. And this is where You're all going to get mad at me because I'm going to put this earworm in your head, but we're going to talk about personal property. All right, that's probably enough of that. So personal property can include real estate, clothes, cars, as you just heard, boats. There's lots of different ways to do it. It can be pieces of land. It can be just about anything that you could give away to a charity that they would have a value for. Now, here's the difficulty with personal property. It can be very difficult to value. Now, you may have heard of people who have donated swaths of land for a park. Well, how do you value how much that land is worth? And it's rife for both abuse and confusion. And so if you're concerned about getting audited, and if you're donating big pieces of personal property like that, you probably should be, you need to make sure you keep your records and have reliable sources of information for how much that value is or could have been. So moving on to some strategies and tips and tricks. So the first thing I'm going to talk about here is qualified charitable distributions. And you can see the definition from the law right there. They're tax-free distributions paid directly from an IRA to an eligible charitable organization. Now, this money that goes never hits your tax form, so it never contributes to your adjusted gross income, which is helpful both in state taxes in many places and then local taxes as well. The caveats are you have to be 70 and a half or older when the gift is made, and the IRS does care about your half birthday. So if you turn 70 on February 1st, you'd have to wait until August 2nd to make a contribution like this, so we've gotten past your half birthday. It has to go from a traditional IRA, not a 401k. And if you're 73 or older currently, you have a required minimum distribution. Money set out for a qualified charitable distribution does count towards your RMD. And so if you're not using your RMD to live on, it's a good way to get that money out without causing additional taxes for you individually. For years, this number was kind of set in stone. Recently, it's been adjusted for inflation. So in 2025, that's up to $108,000 per individual. So if it's married filing jointly and you both have large IRAs, you could, in theory, do up to $216,000. And it is indexed for inflation now, so that number will be higher in 2026. There's been a new interpretation that I think is really interesting. So for years, it was always that for a QCD, you had to call us, we would get the information, we would send the check directly from your IRA. Now, one of the ways it can be done is if you have check writing on your IRA, you can send the checks directly to the charity and it still counts the same. I do have a word of warning there though. So when we send the checks out, the account is credited as giving that money away the date the check is issued. So if you call us on December 30th and say you'd like to do it and we get the paperwork done in time and that check goes out on the 30th, it doesn't matter when it's received or cashed by the charity, it counts as going out on the 30th. If, however, you're writing checks from check writing on your account, that doesn't count as going out of your account until the check is cashed. So you'd want to give yourself lots of buffer room in case it takes the mail a long time to get the check there. It's December, lots of people have vacation time. Maybe somebody who's responsible for cashing those checks isn't there. It could really cause a problem, especially if you're using that money to hit the end of your required minimum distribution. So if you're going to do the check writing piece of that, you want to make sure you get it done plenty early so that you don't run into these issues and cause yourself a real big taxable issue when it comes tax time in April. Another way that you can give to a charity, and I don't think it's used as often as it should, is giving appreciated stock or stock that's gone up quite a bit from a taxable account. So if you gift the shares directly to a charity, and you'd only want to do it with shares with a big gain, you get credit for the amount of the gift that goes to the charity, but you don't have to realize those capital gains first. And if the charity is a 501c3, they're tax exempt, so they're not worried about the capital gains either. So it's a very efficient way, if you have positions that have gone up quite a bit, to give to a charity without having to first take it in as capital gains, but taxable income for you. So the mechanics are quite simple, really. We have to get the donation account information from the charity of choice, and almost every charity has a donation account you can send it to. You have to sign an LOA, which stands for letter of authority, for it to be transferred. So we have all the information laid out. You sign saying, yes, this is what I want to do. It goes electronically for free. And then the value, at least in our case, the value that shows up as the gift amount is based on the market opening value on the day of the transfer. So you don't have to worry about, did it go at 1:30 or 3:30? It's going to be a different number because the stock has moved throughout the day. It's whatever the opening value was, that's what you're getting credited with. There are also an alphabet soup of charitable trusts that can be used. Now, these are going to be mostly for high net worth people because they are complex. It's going to be expensive to create these. You're going to have to get a lawyer involved, probably an accountant involved, probably your financial advisor involved. But there are a number of options out there that are great ways to do some charitable giving in a tax advantage structure based on how you want to do it. And there's lots of different options of how you want to do it, what you want to do with what's left over, how you want the contributions to go. It really is kind of something where you can decide what you want, and there's a form for what you're looking to do. But again, this is something you're going to want to consult with an attorney on to make one of those trusts. And again, it will probably be expensive and time consuming, but if you're in that level of giver, it's worthwhile. So again, like I said, we're just covering the basics. If you have specific questions, I'm happy to answer them. I'd love to hear what you think. And again, if you have questions about any of these strategies, you probably want to talk to your tax advisor. You probably want to talk to maybe your financial advisor, maybe an accountant. But there are lots and lots of ways to give to charities. I know the charities really appreciate it. And so it's a great way to give to them and help out a worthy cause, but also maybe reduce your taxable income as well. Thank you.